I'm John A.G. Tonight, something big quietly happened in Europe, and most people will miss it until it's already reshaped the game. A central bank just signaled that it wants to turn its reserve sheet into a fortress. And the ripple effects don't stop at gold. They reach into currencies, supply chains, and a brewing geopolitical chess match that could reprick silver when the world least expects it. Quick favor before we go deeper. My analytics keep showing a huge chunk of you watch every video but haven't subscribed yet. If you want me to keep pushing back against recycled copycat content and keep these breakdowns coming, hit subscribe and drop a quick comment, even just our John AG, so the algorithm knows this is worth surfacing. And if you want daily updates, quick posts, and my personal takes that don't always make it onto YouTube, plus instant voice notes when something breaks, I've set up a WhatsApp channel and community. The link is in the description. Join it because some of the most valuable context happens between the headlines, not inside them. Alright, here's what we're doing in this video. First, I'm going to walk you through the reserve shock. Why a major European central bank is pushing gold toward a level that starts to resemble a U-system style concentration. Then, I'm going to connect a second story that looks unrelated on the surface. Taiwan risk, silver behavior, and Latin American corridors, but is part of one continuity system. And right near the end, I'm going to give you the one watch this first signal that can tell you whether this move is just the beginning or the moment the system changes. But we need to start with the tape, because the tape is where emotions leak out before narratives catch up. As I'm recording this, long-term yields are a touch softer, the dollar index is slipping, and risk assets are not celebrating. Equities are leaning red, and the tech-heavy side is feeling it more. Gold is ripping higher on the session. Silver has been all over the place, whipsawing enough to shake out anyone trading too tight. And energy is waking up. Copper is firm. Crude is bid. And natural gas is doing that thing gas does, where it looks calm for a week and then decides to move like it's late to its own appointment. Now, don't get hypnotized by the numbers alone. The numbers are the surface. The real story is the why behind the numbers. And the why is changing faster than most people's mental models. Let's talk about the first headline that matters. The reserve decision. A European central bank, one that has been steadily building its bullion position, just greenlit a plan that allows for up to roughly 150 additional tons of gold purchases, which could lift total holdings toward the neighborhood of 700 tons if fully executed. And at current price levels, that pushes gold toward the high 30s as a share of total reserves, call it roughly 37% to 38%, depending on pricing and how you mark the rest of the reserve mix. Here's why. That's not just a fun statistic. When a central bank gets that close to a gold-heavy reserve posture, it's not a trade, it's a statement. It's a structural choice about what kind of world they believe is forming. And that world looks less like global cooperation and more like fragmentation, sanctions, counter-sanctions, blocked payments, rerouted supply chains, and regions that want insulation from external pressure. And the part that should make you sit up is that this isn't a small, quiet country playing pretend. This is a nation positioned right on the fault lines of European security, trade flows, and political alignment. That matters because central banks don't operate in isolation. They watch each other. They mimic what works. They copy what reduces risk. And when a country at the edge of the storm decides gold is the anchor, other institutions notice. Now I can hear the skeptical voice. But central bank gold buying has been talked about for years. Why is this different? Because this isn't just buying. This is moving toward concentration. It's the difference between owning some insurance and building a bunker. And once you see it like that, the next question becomes obvious. What happens to everyone else's reserve strategy when the bunker building accelerates? If you're a neighboring country, do you want to be the one holding mostly paper claims while your peer is stacking a tangible settlement asset? If you're a region trying to project stability, do you want your reserves to be something that can be frozen, blocked, or politically weaponized? If you're managing credibility with citizens watching inflation and currency swings, do you want to be able to say we hold what's real? That's the psychological part. But the market part is even more interesting. Big reserve shifts don't just lift the demand curve. They change the put under the price. They turn dips into opportunities for entities that don't care about your entry price. They care about long-run exposure, which means volatility can increase even as the long-term direction firms up. That's why you can get a session where gold is strongly up, silver is chaotic, and risk assets can't find footing. The allocation process isn't clean. It's messy. It's a tug-of-war. Now, we're going to tie this into silver in a moment. But first, I want to zoom into a detail that gets ignored in mainstream coverage. Reserves are not just about returns. They're about optionality. Gold gives optionality. It can be pledged. It can be swapped. It can be used as collateral in ways that paper assets can't, especially when trust breaks down. And you don't have to believe in conspiracy theories to understand this. You just have to look at the incentives. In a fragmented world, the most valuable reserve is the one that still works when relationships don't. Now here's the cliffhanger. The gold story is the headline. But the real power move is happening in the background of the silver market. And the only reason you're not hearing more about it is because it doesn't fit neatly into a price or narrative. So let's move to story number 2, because it explains why silver can look sleepy one week and then turn violent the next. On the surface, you'll hear people describe the silver situation as demand and supply, or industry and investment, or rates and inflation. And yes, those matter. But right now, silver is also a proxy signal inside a larger geopolitical contest. Think of it this way. Silver is not just a metal, it is a strategic input. It sits in electronics, solar, defense systems, and critical infrastructure. And when global powers think about resilience, they think about the entire chain. Where it's mined, where it's refined, how it's transported, who ensures it, who settles the invoice, and what currency system is used at the end. That's where Taiwan enters the picture. Taiwan is not simply a flashpoint, it is a node. It is a node in advanced manufacturing, in semiconductors, and strategic alliances, and in a broader question. Who controls the rules of trade and security in the next decade? And here's the move that scares people who are paying attention. Major powers are building continuity systems. That means they're designing a plan that still functions if a crisis happens. Not a plan that looks good on paper. A plan that works when ships are delayed, when payments are blocked, when routes are disrupted, and when political pressure rises. In that kind of planning, Latin America becomes more important than most people realize. Why? Because Latin America can anchor corridors, transport routes, processing capacity, resource access, and diplomatic votes in international institutions. It can be the swing region that determines whether an alliance network tightens or fractures. And once you see that, you understand why documents, speeches, and diplomatic pushes keep circling around the same issues. It's not about day-to-day commodity pricing. It's about route control, institutional leverage, and legitimacy. Now, I'm going to keep this grounded because I know this can sound abstract. Let's take a simple example. If a country wants global recognition for a claim, territorial or political, it needs votes. It needs statements. It needs partners willing to echo the language. And one way you build that is by securing economic ties that create dependence. Financing, infrastructure, trade deals, processing plants, logistics projects. Those create incentives for alignment. So when you see Latin America being courted aggressively, don't only think resources. Think corridors plus institutions. And here's where silver comes back in. When corridors and continuity systems shift, the physical flow of strategic inputs changes. And when physical flow changes, spreads change, premiums change, inventory behavior changes, and sometimes the price move is the last thing to show up because the market is adjusting behind the scenes first. That's why watching only a spot chart can leave you blind. You want to know what's really happening? Watch the relationships between markets. Watch the differential between where metal is priced and where metal is demanded. Watch the incentives for moving metal from one jurisdiction to another. Because in periods like this, arbitrage can stop being financial and start being political. The trade might exist on paper, but the metal doesn't move because people are hoarding, because shipping is constrained, because policy risk is too high, or because the real cost of movement is no longer just a freight rate. And when that happens, the usual playbook breaks. Now let me pause for one line to do something I almost never do, because it's relevant to this exact moment. If you want silver-related success stories, real-world examples of how people built wealth, stacked smart, or used metals as a strategy, there's a separate channel linked in the description. Check it out and subscribe there so you do not miss those case studies because they hit different than charts. Back to the main thread. When you have a gold-heavy reserve shift in Europe and a continuity system build-out tied to Taiwan risk and Latin American corridors, you're looking at one overarching theme. Sovereigns are repositioning for a world where trust is thinner. That theme has consequences. First consequence, gold becomes the reserve anchor again. Not because of nostalgia, but because it's functional in a fractured world. Second consequence, silver becomes more sensitive to shocks because it sits at the intersection of strategic supply and industrial necessity. Third consequence, volatility increases because paper markets are trying to price a world that is becoming less paper-friendly. Now let's talk about how you can read the silver market without getting trapped by noise. One of the cleanest tells is the spread behavior between major pricing centers. Think in terms of where the paper sets the reference price and where physical demand expresses itself. When that spread widens or tightens, and when it moves in a specific direction relative to the underlying price trend, it can hint at who is in control. Is it genuine and demand pulling metal, or is it paper supply pushing price? This is where most commentary stays shallow. So let's go one layer deeper. If silver is rising and the premium in a physical demand center is also rising, that's a different regime than silver rising while the premium collapses. In the first case, you can have a signal of tightness. In the second, you might be looking at a rally driven more by paper positioning than physical pull-through. Similarly, if price is falling but premium stays stubbornly elevated, that's not bearish. That can be a signal of underlying demand that refuses to let the physical market loosen. The point isn't to worship one indicator. The point is to stop being fooled by one chart. And now we can bring this back to the Poland story, because here's the key. Central bank behavior changes the backdrop for the entire complex. It can change how much paper gold the market is willing to trust, and it can change how investors interpret drawdowns. If sovereigns are building gold concentration, then gold is not just an asset, it is becoming a policy tool. And when gold is a policy tool, silver, because it's linked by investor psychology, by metal complex flows, and by hedging behavior, can ride the same waves but with bigger swings. That's the setup. Now let me slow this down for the people who like the why more than the wow. Because if you only remember one thing from this entire breakdown, it should be this. Markets don't usually turn on the day the headline prints. They turn when positioning, policy and psychology line up quietly weeks before. The headline is the permission slip for the move that was already forming. So when you see gold up hard while the dollar slips and equities wobble, don't just say gold is strong. Ask what kind of world is gold pricing in right now. Because gold isn't reacting to a single data point, it's reacting to a pattern, governments spending more than they admit, central banks preparing for fractures they won't publicly describe, and investors slowly realizing that normal might not be coming back the way it used to. That's exactly why I want to give you a clearer picture of the market tape, because it sets the emotional tone that the rest of the day's narratives will try to justify. When long bonds ease even a little, it tells you the market is flirting with the idea that growth isn't as strong as the cheerleaders claim, or that a policy shift is coming. When the dollar fades at the same time, it suggests global money is less eager to hide in cash. When stocks are down while gold is up, you're looking at a risk rotation. That's not always crash mode. Sometimes it's just a rebalancing. But when it persists, it's a change in preference. And preference is everything. Now silver's behavior is the clue that people ignore because they want silver to behave like gold. It won't. Silver is a hybrid. Half monetary psychology, half industrial reality. That means it gets yanked by two leashes. On nights when traders are nervous, silver can drop even as gold rises because silver gets lumped into the risk metal bucket. And then when the panic passes, silver snaps back because physical demand doesn't disappear just because a screen turns red. Energy being firm at the same time adds another layer. Oil and gas are not just commodities. They are cost structures. They are inflation pulses. They are geopolitical levers. If energy starts to climb while currencies soften, the inflation is finished. Story gets harder to sell. And that matters because the moment real rates stop being attractive, hard assets start winning again. Here's the cliffhanger I promised. The reserve story and the Taiwan story look separate. They are not. They are both about insulation, and insulation is the new growth. Now back to that reserve decision, because the numbers can feel abstract until you translate them into behavior. A central bank saying we can buy up to 150 more tons is not the same as we will buy 150 tons tomorrow. It's the creation of a runway. It tells the market we have permission, funding pathways, and political will. And that changes expectations. Expectations are the fuel for trend extensions. Let me give you a simple mental model. Imagine reserve managers sitting in a room with 3 columns on a whiteboard: liquidity, safety, and control. In a stable world, liquidity dominates. In a fractured world, control rises in importance. And when control rises, assets that cannot be easily frozen, blocked, or diluted become more attractive. Gold has no counterparty. That's the whole point. Now, when bullion becomes a larger share of reserves, it does 2 things at once. It reduces exposure to other nations' policies and it increases domestic confidence. That second part gets overlooked. Citizens may never read a reserve report, but they feel currency credibility in prices, wages, and trust. When policymakers load up on hard assets, they're also sending a signal inward: we're preparing, and preparation is contagious. If one country in a region prepares, its neighbors start asking, what do they know that we don't? That's when mimicry begins. And that is why gold can move faster than people expect, because the marginal buyer isn't always a retail investor chasing a candle. Sometimes it's a quiet institution that doesn't care about being early. It cares about not being late. Now here's a small but important nuance. When people argue about central bank buying slowing, they often talk in tons, not in dollars. Tons matter for physical flow, but dollars matter for signaling power. If the gold price rises and the tonnage slows, the value of buying can still be enormous. The market hears the value signal and responds. So if you see fewer tons but similar spending, that's not weakness. That can be persistence. And persistence is what builds multi-year trends. Now let's connect this to the part that creates the most confusion. Why silver doesn't always follow gold immediately. Think of silver as a spring. Gold moves first because it's the pure monetary hedge. Silver moves later and then it overshoots. Because once capital rotates into metals, silver becomes the high beta expression. That's why silver can feel dead and then suddenly feel unstoppable. But there's another reason, and it's the one most people underestimate. If industrial users sense risk, shipping delays, policy shocks, route disruptions, they start to secure supply earlier. They hold more inventory. They sign contracts. They pay premiums. That process doesn't always show up instantly in the spot price. It shows up in spreads, in delivery terms, and in where metal is flowing. And that brings us back to Taiwan and Latin America. Most people talk about Taiwan like it's a binary, peace or conflict. But the world doesn't operate in binaries. It operates in probabilities and preparation. Even a small increase in perceived risk changes behavior because supply chains don't like uncertainty. They seek redundancy. Redundancy means new routes, new processing, new partners. And when redundancy becomes policy, Latin America becomes strategic terrain. Why? Because it can be a bridge, a buffer or battleground depending on who builds the infrastructure and who writes the financing terms. Processing plants, ports, rail, power projects, data cables, these are not just development, they are leverage. And leverage is what determines who gets the last word in a crisis. Now here's the part that makes people uncomfortable. In global contests, countries don't always fight for a metal because of today's price. They fight because of tomorrow's dependency. They fight to ensure they can keep building, keep producing, and keep settling trade even if someone tries to choke them off. So when you see diplomatic outreach tied to resources and corridors, it's not a side story, it's the story. And silver becomes a surface-level indicator because it sits inside so many critical systems. It is the kind of input that doesn't get headlines until there's a shortage. And once there's a shortage, you're already late. That's why I'm pushing you to think in continuity architecture, not spot chart. A continuity architecture has 4 layers. First, diplomacy, agreements, recognition, votes, alliances. Second, logistics, ports, shipping routes, rails, choke points, insurance. Third, resources and processing, mines, refineries, smelters, manufacturing. Fourth, settlement, currencies, payment networks, clearing systems, collateral. When those 4 layers align, a country gains strategic resilience. When they don't, it's vulnerable. Now here's the cliffhanger. The market is starting to price in that these layers are aligning in new ways. And the first place you'll see the stress is not in the headline price. It's in the spread between markets that are supposed to be connected. Because when connection weakens, spreads talk. If you've ever watched a normally tight spread suddenly widen, you know what that feels like. It's the market whispering something is off. And when something is off, it can be either a short-lived glitch or the first crack in a system. The job is to tell the difference. One method is to watch how spreads behave during directional moves. If spreads widen while price rises, it can reflect demand pulling physical in certain places. If spreads narrow even as price rises, it can reflect supply pressure or easing constraints. If spreads widen during a price drop, it can suggest physical tightness beneath paper selling. None of this is perfect, but it's better than guessing. Now let's talk about what could happen next, because people always ask for scenarios. Scenario 1, the reserve shift continues quietly and gold keeps trending. In this scenario, silver eventually catches up and starts to run, but it runs with turbulence. You get sharp drops, sharp rebounds, and a lot of people get emotionally exhausted. Scenario 2, a major geopolitical headline hits, either escalation or a sudden dunt, and metals spike or flush. In this scenario, you get a violent move that feels like a final move, and then you realize it was just a chapter. Scenario 3, policy surprises, rate cuts, liquidity injections. Fiscal packages push investors out of cash and bonds and into hard assets. In this scenario, metals gain not because of fear, but because of math. Too much money, too few real things. When gold makes a new range and holds it, that's information. When silver refuses to break down despite chaos, that's information. When spreads in premium stay stubborn, that's information. Alright, Now we have to talk about the psychology of reserve concentration, because it's the part that produces virality when people finally realize what's happening. When a country pushes gold toward the high 30% share of reserves, it's not only insulating itself, it's also challenging the assumption that the dominant reserve asset should remain dominant forever. It's a subtle vote against the current order. And when enough votes stack up, the system changes. That doesn't mean the dollar disappears tomorrow. It means the direction of trust shifts. And when trust shifts, the pricing of everything shifts. Now, silver's role in this is almost comedic because silver is the metal that gets dismissed until it becomes essential. It's the boring metal that suddenly becomes the critical metal. And here's a weird truth. Markets often move hardest when the consensus is still skeptical. When everyone is fully convinced, the move is usually older than people think. So if you see the public still distracted while institutions quietly adjust, that can be the early stage, not the late stage. Now let me give you a practical action that doesn't involve financial advice. Build awareness habits. Pick 3 indicators you'll track weekly, not hourly. Weekly. Indicator A, a key gold level and whether it's holding. Indicator B, a key silver level and whether it's holding. Indicator C, one spread or premium measure that reflects physical stress. If you do that, you'll stop being surprised by every headline. You'll start seeing the storyline before it hits mainstream. Now I want to pull one more thread on Latin America because people underestimate how quickly corridors can change the map. If you control a corridor, you control throughput. If you control throughput, you control bargaining power. And bargaining power is what turns resources into influence. That influence can show up as votes, as recognition, as trade terms, as access, as security cooperation. So when you hear infrastructure investment, don't hear construction, hear alignment. And when alignment shifts, the risk profile of the world shifts. Now let's bring it back to you, the viewer, because I don't want this to be a lecture. I want this to be a conversation. Here's what I want from you. In the comments, tell me which thread you're watching most closely. The reserve shift, the quarter game, or the silver signal. Then tell me what would change your mind if new information hits. Keep it short, 1 or 2 sentences so others can scan it. This helps me shape the next breakdown, and it helps the whole community sharpen their thinking together. If you're new here, just say you're here and I'll welcome you. Now before we close, one more reminder. The members-only video should be live by the time you see this. That members-only episode bundles the latest updates in one place and goes deeper than we can go here. More context, more nuance, more why this matters. If you want to join membership and watch that full premium rundown, the link is right here on the channel. It's also the easiest way for me to see who's genuinely following the work. And again, WhatsApp link in the description for daily posts, voice notes, and instant alerts. And lastly, if you've succeeded in anything, medals, business, a new job, a disciplined habit, I want you to share one sentence in the comments. It helps more people than you realize. Alright, here's the final takeaway. And it's the one I want you to replay in your mind. Reserves are becoming fortifications, corridors are becoming chessboards, and silver is becoming a sensor. The price is the headline. The system is the story. Subscribe if you want more of this. Drop your comment and I'll see you in the next video because the next move might already be forming while everyone else is arguing about